What if the app that helps you budget could also unlock better loans, faster payments, and smarter money tools without ever becoming your bank? That is the promise of open banking. But here's the problem. Most people hear the words open banking and instantly think unsafe, confusing, or some kind of trick. And one of the biggest myths might be stopping regular people from using financial tools that could actually help them save money and make better choices. Number 1, open banking does not mean your account is public. The biggest myth starts with the word open. People hear open banking and imagine their checking account floating around the internet for anyone to grab. That is not what it means. Open banking usually means you can choose to let a trusted app securely connect with your bank data through approved technology. The key word is choose. Your account is not public, your data is not posted online, and the access is usually limited to what you approve. Think of it like this. Giving a budgeting app permission to see your spending is not the same as giving the whole world your bank password. It is more like giving a delivery driver access to your front gate, not your whole house. Number 2, it is not about replacing banks. A lot of beginners think open banking is some new system trying to destroy banks. Not really. In many cases, it works with banks, not against them. Open banking lets banks, apps, and financial tools connect more smoothly. That can help you see all your accounts in one place, compare products faster, or move money more easily.
For example, instead of opening 3 bank apps, 1 credit card app, and 1 investment app, a money dashboard might pull everything into one screen. The bank still holds your money. The app just helps you understand it better. Number 3, you still control permission. Many people assume that once they connect an app, they lose control forever. That fear keeps a lot of people from even trying useful tools. In reality, permission is a huge part of open banking. You often approve what data is shared, for how long, and for what purpose. In many systems, you can also disconnect access later. Imagine you use an app to apply for a loan. Instead of printing bank statements, you approve temporary access so the lender can verify your income and spending. After that, the access can expire or be removed. That is very different from handing someone unlimited control. Number 4, open banking is not the same as giving away your password. This one matters a lot. Some people think open banking means typing their bank login to random websites. That has happened in older systems, but modern open banking aims to reduce that risk by using safer connection methods. The goal is usually secure data sharing through approved channels, not password sharing. That lowers the chance of your login details being exposed. A simple example is signing in through your own bank's secure page, where you approve access directly, instead of sending your password to a third party. That extra layer is one reason many experts see properly designed open banking as a step forward, not backward. Number 5, it is not only for tech experts. Open banking sounds like something built for coders, startups, and people who use words like API before breakfast. But the real value is often for ordinary people. If you have ever wanted one app to show your bills, savings, debt, and spending in one place, that is the kind of thing open banking can support. If you have ever wanted faster account verification or easier payment setup, same story. A college student tracking rent, groceries, and subscriptions could benefit. A parent trying to compare savings accounts could benefit. A freelancer with uneven income could benefit. This is not just for finance nerds. Number 6, it can help you make better money decisions. Some people think open banking is just a fancy data pipe with no real value. But when used well, it can turn scattered information into useful insight. Many Americans say budgeting is stressful because they don't have a clear picture of where their money goes. When your financial data is organized better, patterns become easier to spot. For example, maybe you think you spend $50 a month on food delivery. Then your app shows the real number is $180. That one surprise can change behavior fast. Or maybe you realize your paycheck always arrives 2 days before a big bill, which helps you avoid overdraft trouble with better planning. Number 7. It is not automatically unsafe. Now, let's face the fear directly. Is there risk? Yes. Every digital financial tool carries some risk, but that doesn't mean open banking is automatically unsafe. What matters is how the system is built, how the provider handles security, and whether the user is careful. Encryption, permission controls, fraud monitoring, and clear consent rules all matter. Think about online banking itself. Years ago, people thought checking balances on a phone sounded reckless. Now it is normal. New financial tools often look scary before they look familiar. The smart move is not blind trust. It is informed caution. Number 8. More data sharing does not always mean more harm. This sounds backward, but sometimes better data sharing can reduce friction and mistakes. Without open banking tools, people often email statements, upload screenshots, or type details by hand. That can be slow and messy. With secure, permission-based sharing, the process can become faster and cleaner. A lender can verify information more accurately. A budgeting tool can categorize spending more clearly. A payment service can confirm ownership faster. Example, instead of scanning 3 months of statements for a rental application, a tenant may allow limited account verification. That can save time and reduce paperwork headaches. Number 9. It is not just about budgeting apps. Budgeting is only one piece. Many viewers think open banking begins and ends with colorful spending charts. It can do much more. It may help with account switching, loan comparison, income verification, saving tools, financial coaching, and smoother payments. In some cases, it can even support more personalized offers based on real financial behavior. Picture someone trying to find a lower fee account. Instead of guessing, a tool could review their actual transaction habits and suggest an account that fits better. That is practical, not futuristic. Number 10. Open banking does not guarantee better products. Here's a myth from the other side. Some people assume open banking always leads to amazing deals. Not always. Better data can help companies serve people better, but it does not guarantee lower costs, perfect advice, or magical savings. A bad app with access to data is still a bad app. That is why users still need basic judgment. Read the terms. Understand what data is being shared. Ask what problem the app solves. If a tool adds no real value, skip it. Number 11. Consent screens matter more than people think. Most people rush through permission screens like they are trying to escape a burning building. That is a mistake. Those screens often tell you what data is requested, why it is needed, and how long access lasts. That is where you find out whether an app needs transaction history, balance data, identity details, or only account confirmation. For example, a savings app may only need to see balances and spending categories. If it asks for more than that, pause and think. The details matter. Number 12. Open banking can support competition. One quiet benefit of open banking is competition. When consumers can move data more easily, it becomes harder for financial companies to trap people with inconvenience. That can push providers to improve prices, features, and customer experience. In simple terms, if switching becomes easier, companies have to work harder to keep you. Think of mobile phone service years ago. When changing providers got easier, companies had to compete more aggressively. Finance can work the same way. Number 13. It will not fix bad money habits by itself. This myth is sneaky. Some people believe the right app will magically solve overspending, debt problems, or weak saving habits. Tools can help. They can show patterns, send alerts, and make decisions easier, but they cannot build discipline for you. Open banking gives visibility. You still have to act. If a person keeps ignoring alerts, opening 3 budgeting apps will not save them, but one good app used consistently can make a real difference. Number 14. The best use is often small and practical. People expect something dramatic. In reality, the best use of open banking is often boring in the best way. It may help you verify income faster. It may help you avoid missing bills. It may help you see hidden subscriptions. It may help you compare accounts based on real habits. That does not sound flashy, but saving even $20 here, $40 there, and avoiding one overdraft fee can add up in a big way over a year. Number 15. The real question is not, is open banking good or bad? The better question is this: when does it help? When does it not? And who controls the choice? That shift matters. Open banking is a tool. Like any tool, it can be useful, useless, or risky depending on how it is designed and used. The smartest beginners do not panic, and they do not blindly trust. They learn just enough to make informed choices. And that may be the myth that confuses most people. Open banking is not really about opening everything. It is about giving you more controlled ways to use your own financial data. So before you write it off as dangerous hype or believe it will solve every money problem, remember this: the power is not in the buzzword. The power is in understanding what you are sharing, why you are sharing it, and what you get back in return. What is the biggest myth about open banking that you believed before hearing this?